everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 395 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to talk about something that is fundamental to finance because you know that I like to do these Fundamental Friday episodes, and today's episode is on compound interest, or the eighth wonder of the world, as it has been called. And so I think that we need to understand what compound interest is so we can better understand how our debts work, how our investments work, and it's really fundamental to how finance works and how we understand the value of money over time. So stay tuned for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, look, have you ever taken out a loan and wondered, how in the world did they come up with my payment, right? Where does this payment come from? Why is this payment, whatever it is, right? Or have you ever invested some money and, looked up 5 years later and went, how in the world did that turn into that? Or looked up 40 years later and go, how in the world did that turn into that, right? Well, all of this has to do with this idea of compound interest, right? And like I said in the opening, compound interest has been called the eighth wonder of the world because it is a fantastic tool. It's a fantastic tool that can work for us if we invest, and it can work against us when and if we borrow, right? Now, compound interest, it is the interest on a loan or a deposit calculated based on both the initial principal and the accumulated interest from previous periods. So let me put that in layman's terms for you, right? Compound interest is simply this, right? It is when you have some value of money, right, that grows, and then when it grows again or grows some more, it's not just growing based on that initial amount of money. It's growing again based on the new amount of money. So I'll give you a couple of examples, simple examples to start, right? So let's say you invest $100, right? You invest $100, and over the course of a year, that $100 might make 10%. Right? So you have $110 after 1 year. But then what about the next year? You make 10% again. Well, in the first year, you made $10 by making 10%. Well, in the second year, you're not going to make $10. You're going to make 10% not of the original 100, but you're going to make 10% of the 110, right? So you make $11 in the second year, and so your new balance is $121. Then again, you're going to make 10% the next year. And so now the new balance is $133.10 because you made 10% on $121, which is $12.10, right? So pretty simple, pretty easy idea, right? So the idea of compound interest is thought of as interest on interest, right? You're not just growing your money at what we call simple interest, right? Simple interest would be like if I make 10% on the 100, right? Then the next period I make $10 again, right? And then I make $10 again, and it's always based on the principal value. And when I say principal value, I mean the initial value, right? And so it would be making 10% on the initial value every time instead of making some percentage on the new value every single time. And that's why I think it's particularly interesting when you look at stock charts, right? And so, for instance, I'll just give you this. Peloton, right? Peloton has had a horrendous time as of late. The stock over the past year is down, over 80%. It's just horrendous bad, right? Well, I heard somebody say on a podcast the other day that Peloton was down 70% at one point. And if you would have bought Peloton when it was down 70%, you would then be down 50%. And I was trying to think, that doesn't make any sense. What do you mean? Well, what it means is, let's say, just approximate, right? What was Peloton's high? 157.83, right? So 157.83 was their high stock price, right? Well, then it was down 70%. So that means it had decreased to $47.35. And they said if you bought it right there, then you would be down 50%. So you would be down 50% based on that particular price. So that price turns out to be $23.67, right? So you would have been down 50%. But if you look over the grand scheme of things, how much are you down based on the original value? Well, you would be down what? You would be down 85%, right? Not 70 and then 50 again. No, you're down 85% because the stock is not based on these, simple day-to-day movements. It's based on a longer term. But if you look on day-to-day portions, or you break these longer terms into shorter amounts, then what you're going to end up finding is that, hey, you can be down 50% from 70% down, and it ends up making a lot of sense as to where you are. But let's jump back to compound interest. That's just another example that we can look at. So the rate at which compound interest accrues depends on the frequency of compounding, such that the higher the number of compounding periods, the greater the compound interest. Thus, the amount of compound interest accrued on a $100 compounded at 10% annually will be lower than the $100 compounded at 5% semi-annually over the same time period, because the interest on interest effect can generate increasingly positive returns based on initial principal amount. Compounding has sometimes been referred to as the miracle of compound interest. So what's that mean, right? So they're talking about compounding periods. Well, let's just think about this, right? If you take out a home loan, how often do you make a payment? You make a payment monthly. Okay. And so that payment is based on the interest rate that is prevailing, right? And the amount that you took out the loan for, right? And then how long the loan is for. And so when they come up with the interest portion of that first payment, right, they do so based on compound interest. They do so on a monthly basis. So let me just give you a quick example as to how this would look on, let's say, a $300,000 loan, right, with a 3% interest rate, and this is a 30-year loan, right? So you take that $300,000, you multiply it by 3% divided by 12 because it's monthly payments, and that first payment's going to have $750 of interest, right? And I said this was a 3% loan over 30 years, right? The initial value is that $300,000. Right, you pay that loan off. Your payment is going to be, the principal and interest portion of your payment is going to be $1,264.81, right? And so since that is the case, then we can just take that payment amount and subtract the interest amount. So we can take that minus the interest. And so $514.81 will actually be the decrease in the amount of your loan during that first payment, right? So actually, after that first payment, your balance didn't decrease by the total amount of your payment. It just decreased by the $514.81, right? And then you just continue on, right? And so it will continue on, let's just say, for that first year, right? I just want to be clear about that first year and exactly what that first year is going to look like. So based on compound interest, based on the fact that you are paying interest, every single period over that first year, you will end up paying $8,914.34 in interest over that first year based on monthly compounding, right? But if you would have just said, okay, well, what about, instead of that, what about if we just took, 3%, a full 3% of the 300,000, right? You could say, okay, 3% times 300,000 is what? It's $9,000, right? Well, that's more interest. Why does that make sense? Well, it's because your loan is decreasing in amount every single month, right? Therefore, the amount of interest that you end up paying on that loan over the course of that first year would be less than it would be on an annualized basis. And the opposite would be true with your investment growth, right? The more compounding periods with investment growth, the higher the value is going to be, and the less compounding periods, the less the value is going to be, right? So that's just a simple example to show you. So you, again, $8,914.34 of interest in that first year versus $9,000 if we just talked about one annual payment on that mortgage, right? So you end up paying less in interest in that way. Now, how does compound interest work, right? It's calculated by multiplying the principal value by 1 plus the annual interest rate raised to the number of compounding periods minus 1. All right. So the total initial amount of the loan is subtracted from the resulting value. Okay. So basically, that is just to determine the amount of interest that ends up getting paid. So anytime I'm trying to grow something, grow some value. So let's say we go back to that $100 example, and I'm saying 10% a year on $100, right? What we're doing there is I'm just saying $100 times 1.1. So that's the initial value times 1 plus the interest rate. And yes, it's raised to the number of compounding periods because I'm just looking for one period, right? And that gives me 110. And then I'll multiply that by 1.1 to give me 121, and multiply that by 1.1 to give me 133.1. But if I wanted to, I could just take the $100, right, and multiply that by 1.1 raised to the third, and that would also give me 133.1, right? Because that's how the compound interest formula works. Now, because compound interest includes interest accumulated in previous periods, it grows at an ever accelerating rate, and it's not like this straight line, right? I think that's what people think when they look at investment charts sometimes, that if your money grows, it grows like this. It grows like a 45-degree angle. It's not true, right? Your money does not grow like that. Maybe in the short term, it looks like that, but I implore you, go and, I mean, there are some amazing charts out there that can really show this to you. I mean, the S&P 500, you could absolutely look at that, right? You can look at the S&P 500 on Google and click max, and you can see how the chart, it looks like this long, and it looks like it did nothing for a long time, and then it starts increasing, and then starts to curve upward, right? It's this exponential growth. There are other stocks that I think can give you a much clearer view of this, right? If you go and you looked up Microsoft, for example, Microsoft is a great example of exponential growth over time, because again, for a long time, it looks like that stock doesn't do anything, even though it is growing during that time, right? But it's growing in such small dollar amounts. But then all of a sudden that compound interest catches up, and then the thing like shoots upward, right? This is parabolic move, and it's the exponential growth of money over time, right? That's an outstanding chart to look at. And my guess is Apple would have a very similar chart. You can look at Apple. Yeah, Apple's chart as well is just outstanding. And theirs was a long time of looking basically flat and then starting to get the exponential move, right? So that's how your money ultimately grows, because you're making interest on interest, not just interest on the initial value. Because if you were just making interest on the initial value, you were making simple interest, then you would have this 45-degree angle, because you would have the exact same rate of change every single time, right? The dollar value by which your investments would change every time would be the exact same, right? But it changes by more each time via compound interest, right? So like I said, with the $100, you make $10 the first time, then $11 the second, and then $12.10 the third, right? So it's ever increasing in value over time, right? So you see that exponential growth. Now, compound interest can significantly boost investment returns over a long period of time. While a $100,000 deposit that receives 5% simple annual interest would earn $50,000 over 10 years, the annual compound interest of 5% on $10,000 would amount to $62,889.46 over the same period. If the compounding period were instead paid monthly over the same time period at 5% interest, the total interest would instead grow to $64,700.95, right? So a very staunch difference between simple interest and compound interest, right? And this is why it's so important to invest your money over time, right? Because you feel like, the amount of money I can invest, there's no way that I can, end up building up to being a millionaire or whatever. Let me just give you an example, right? If you have $250, okay, a month, and you invest $250 a month over, let's go over a long period of time. Let's say 40 years. That's $120,000 that you invested, okay? So $120,000. How much do you think that money actually would turn into in the stock market? And let's just assume over the past 40 years, a 10% rate of return, even though I think it is probably a little higher, right? But we'll just do the math anyway. So over the last 40 years, if you were investing $250 per month, you started with nothing, you would end up having $1.581 million, okay? And you would have only put in $120,000, right? So the amount that you put in percentage-wise to what you end up having is only like, what was that, 8%, right? Or let's see, 7.59%. Right? 7.59% of your total balance after 40 years was the money that you put in. It's because your money grew at that ever increasing rate and your growth became 92.41% of the overall value of the money that you have. Okay? It is a very, very big deal. Now, interest can be compounded on any given frequency schedule from daily to annually. I'll just give you some examples here, right? So for instance, your student loans, and this is, I think, a big downfall to student loans, and I think it should not at all be done this way, but it is. The interest on your student loans is compounded on a daily basis, right? So every single day you're accruing new interest on your student loans, and you're like, well, that stinks. How does that work? Well, let's say you have a $30,000 student loan, right? And let's say you have a 5% interest rate. Well, you'd say, okay, well, over the course of the year, if I paid nothing on it, let's say while you're in school, and maybe it's accruing interest, it's that type of loan, then after a year, I would have accrued $1,500 in interest, right? 5%, $1,500 on $30,000 is 5%. Well, no, that's actually not correct. That's actually not what would happen. It's going to be daily compounding of your money. So, again, we can look at that 5%, but it's over, not quite 365 days, but we'll just say 365 days for the sake of argument here, right? And so you look over 1 year, and then what do you end up having? You end up finding that you would have accrued $1,538.02 in interest. And you're like, okay, well, $38.02 isn't bad in interest over the course of that year. Okay, maybe not. But let's say it was $100,000 in student loans. Well, that would have been, instead of $5,126.75. Let's say you're a doctor and you had $300,000 in student loans, which I can't even imagine. That would have been another $380.25 over the course of the year, right? So it increases the amount of money that you pay in interest based on more compounding periods, all right? The most commonly used compounding schedule for savings accounts is daily. For a certificate of deposit, typically compounding frequencies are daily as well, but they could also be monthly or semi-annually. For money market accounts, it's often daily. For home mortgage loans, home equity loans, personal business loans, credit card accounts, it's typically monthly, right? There can also be variations in time frame in which the accrued interest is actually credited to the existing balance. Interest on an account may be compounded daily, but only credited monthly. I think that's typically the case with like your student loans, right? It's only when the interest is actually credited or added to the existing balance that it begins to earn additional interest in the account. And I think that's also true with certificates of deposit. Now, some banks also offer something called continuous compounding, which adds interest to the principal at every possible instance. For practical purposes, it doesn't accrue that much more than daily compounding unless you want to put money in and take it out in the same day. More frequent compounding of interest is beneficial to the investor or the creditor, but for the borrower, it is, the opposite's true. It's more costly to the borrower. So, when calculating compound interest, the number of compounding periods makes a significant difference. The basic rule is that the higher the number of compounding periods, the greater the amount of compound interest. Compound interest is closely tied to the time value of money, which I've already kind of given you a little bit of that today, as well as the rule of 72. Now, the rule of 72, my opinion, is super interesting. All right, I think the rule of 72 is very interesting, and it's crazy how approximately correct the rule of 72 is. So I'll give you an example here, right? So let's say that you were going to make, let's say 6% a year on your money, right? I can tell you how long it's going to take approximately to double your money, right? The rule of 72 would tell me that it would take 12 years approximately to double your money. So let's just go with the $100 example, right? And let's say you made 6% a year on the $100, right? And so let's say that, I just said that it's going to take 12 years. It's going to take 12 years to double your money. Well, lo and behold, you go 12 years into the future, guess how much money there is? $201.22, right? So approximately doubled your money. And then I could guess that it would take another 12 years at 6% to double your money again. You'd say, well, how in the world do you know that for sure? How do you know that's the case? Well, you go another 12 years in the future, you got $404.89. And you're like, well, how does that work? Well, the rule of 72 says if you take 72 and divide it by the rate of return that you expect to make, it written in an integer form. So just written as like, if it's 6%, just written as 6, not 0.06. Or if it's 10%, written as 10, right? So you take 72 over 6, for example, and 72 over 6 is what? 12. So that tells you how long it's going to take to double your money. I think that's a really cool tool. And so if you're investing a lump sum of money and you expect to make a certain return, you can have a general idea of how much money you're going to have however long in the future you want to look forward. All right. So again, I think this is a super interesting little concept and can be very well used as an approximation tool for investors. Now, the compound annual growth rate, the CAGR, is used for most financial applications that require the calculation of a single growth rate over a period of time. So let's say your investment portfolio has grown from 10,000 to 16,000 over 5 years. What's the compounded annual growth rate? Well, essentially what this means is that you look at a $10,000 present value, $16,000 future value, and then 5 years in between. So if you use a financial calculator or Excel, it can be shown that it's 9.86%. You may say, okay, well, how in the world do they come up with 9.86%? That kind of seems weird. Wouldn't you just take 16,000, right? You could take 16,000 divided by 10,000, and you're left with what? Okay, 1.6. Couldn't I just take that and divide it out and divide it by however much, divide it by 5 or whatever, and then subtract 1? Wouldn't that work, right? Wouldn't it work if I subtracted by 1 and divided by 5? Wouldn't that be approximately correct? Well, no, it's not, because of the compounded growth of money over time, right? So again, if we want to plug this into Excel, right, you would use a rate function. So you could say rate, and then here the number of periods is 5. There's no payment. The present value is 10,000, and then future value is 16,000, and you would come up with exactly that 9.86% annualized rate of return. And then you could take that $10,000 and you could put this to the test. So if I took $10,000 times, right, you take that multiplied by 1 plus that 9.86%, and you just pull that out 5 years, then you're going to have what? You're going to have exactly $16,000. Okay. So that's how the compounded annual growth rate can work. Now, it is extensively used to calculate returns over periods of time for a stock, mutual fund, and investment portfolios. It's also used to ascertain whether a mutual fund manager or portfolio manager has exceeded the market's rate of return over a period of time. If, for example, a market index has provided total returns of 10% over a 5-year period, but a fund manager has only generated annual returns of 9%, the managers underperform the market. The compounded annual growth rate can also be used to calculate the expected growth rate of investment portfolios over a long period of time, which is useful for purposes such as saving for retirement. Okay, so this is a useful concept and something that we can put into practice. So, what are the pros and cons of compounding? Though the miracle of compounding has led to the story of Albert Einstein calling it the eighth wonder of the world or man's greatest invention, compounding can also work against consumers who have loans that carry very high interest rates, such as credit card debt. A credit card balance of $20,000 carried at an interest rate of 20% compounded monthly would result in a total compound interest of $4,388 over 1 year, or about $365 a month. On the positive side, compounding can work to your advantage when it comes to your investments and can be a potent factor in wealth creation. Exponential growth from compound interest is also important in mitigating wealth eroding factors such as increases in the cost of living, inflation, reduced purchasing power, all these things. Mutual funds offer one of the easiest ways for investors to reap the benefits of compound interest. Opting to reinvest dividends derived from the mutual fund results in purchasing more shares of the fund. More compound interest accumulates over time, and the cycle of purchasing more and more shares continues to help the investment fund grow in value. Of course, compound interest can work well for the investor and work against the debtor, work against the person who is taking out loans, taking out debt. But it is a vital concept to finance. It's a vital concept to knowing how payments work, to knowing how the growth of your money works, and to be able to keep up with those types of things. This is a fundamental concept. It's very simple math. There's some very simple Excel formulas or things that you can use, tools like a financial calculator or whatever else, right? But this is something that I teach. I teach this in a fundamentals finance class, right? In a principles of finance class, I teach compound interest, and it's always valuable and can be useful to just about anybody who takes any type of part in the financial system. So hopefully this is helpful to you, helps you to understand how your money grows and or how your debts grow over time, and it can motivate you to do two things. It can motivate you to invest and grow your money, and can motivate you to get out of debt so you don't have to pay people more and more money over time. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in Monday as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.